Joining us now is Jeremy Nelson, partner at Element Wealth. Jeremy, welcome back. Good to see you.
Thank you very much. I always like coming in here and hearing Rhino say, Friday, y'all.
Absolutely. Well, it's been a busy week here from an economic perspective, right? We've had the GDP numbers, the CPI. Today we got personal consumption expenditures. We've had a large number of big names report financial results, quarterly results. So this has been a compressed week of a lot of info.
Fed raised rates.
Yeah, right. Fed meeting.
So,
Sure.
It's been a lot of news to digest.
Yeah.
Yep.
Yeah. So, but it's been a pretty good week for the markets. The Nasdaq in particular has been powered by some reports, Microsoft and Apple, Amazon. Amazon, we were just talking about that, and I think it's worth saying and talking about this some more. It's one of the most misunderstood companies from a financial structure, a business model perspective, and I think some of that is fueled by the fact that those in Congress who want to change the tax structure, particularly the way we tax corporations. Amazon's always the one they point to. They didn't pay any income tax, and they never drill behind the scenes and explain why didn't they pay any income tax? Because their revenue's, 450, 500, approaching $500 billion, I think, this year on run rate. And they never really dig into, well, here's why they didn't pay any income taxes, but they just report it. And many people are surprised to learn that they not only don't make money in the e-commerce business, they're losing money this quarter, last quarter.
Yeah.
They only make money on Amazon Web Services.
Yeah. Yeah, so Amazon is a really interesting company in the sense that they kind of dumb-lucked into their profit model. They
That's
realized,
exactly right.
Hey, we've got all of these servers for ourselves. Why don't we go lease the space out because we've already got it, and that turned into the profit driver of the business.
Yes, it's what we commonly refer to as the cloud. They were an early adopter, and you could see that coming, but it's Amazon Web Services, and it is a very sophisticated suite of offerings that I've watched, having been in the industry, how they've enhanced that and expanded that, and it's widely used. It generates a fraction of less than 10% now of their total revenue.
Yeah.
But it's the only thing that makes money for them. And I think a lot of people, even at a time when the e-commerce business was making money, such as about this time last year, that was through the roof with everybody coming back from the COVID stuff. Still, though, the vast majority of their profit was contributed by Amazon Web Services, not all that stuff we buy online. It's amazing.
Absolutely, and it will continue to be that way. The e-commerce business is a very, very low margin business for them, but it creates the opportunity. It gets so many people to them that it creates the opportunity for all sorts of other things.
Yeah. And so a lot of folks say, well, what exactly is that Amazon Web Services? Maybe the best way to describe that is if you just look at your phone, I think everybody out there has got a phone, it's probably safe to say 2/3 or more of the apps on your phone, they live in Amazon Web Services cloud.
Yep.
Simple as that. So those companies are paying Amazon to host their programs and data, which you are accessing as a user, as a consumer. And so, and Microsoft had fantastic, a surprisingly positive report, I should say, but their guidance was really good as well.
Yeah, well, the anticipation is that earnings might slow a little bit, but not as much as expected with Microsoft.
Right.
And so that's why things are
Faster
up
started
there.
getting back in.
You're seeing their cloud business is slowing down a little bit, but not as much as people thought it might.
It's still incredibly profitable. It's incredibly valuable. In the demand, it may pause a little bit just based on overall macro headwinds, but long term, there's still lots of upside for that.
Well, and I think that Microsoft went through this transition in their revenue model where, it used to be I get, my Office 365 or Office 2012 or whatever it might have been, and I paid $365 for it, and then I was cheap and I didn't upgrade it until I got a new computer and had to. Well, now they've gone to this subscription service and like video conferencing with their teams and things like that. So, I mean, I know us as a business, we use Microsoft Office 365 and love it. And we pay our, $24 a month or whatever it is, and we're happy as a lark.
You send your money to Redmond every month for the privilege of using Microsoft products. In the investment community, it's fair to say, loves subscription-based revenue.
Yeah, because it creates a smoother revenue stream.
Predictable.
And it's predictable. It's easier to forecast.
Yeah. When I was going to the investment community raising money, the subscription side of our business, they love that. I mean, they're all over you on that. But that one-time big project side of the business, they heavily discounted from a valuation perspective. As you know, it's too lumpy. That's the technical term.
We can't bank on it, right?
Right. It's too lumpy. They love that subscription service. And you see lots of other industries that are starting to sort of transition. The automobile industry is widely thought is one day going there as well. You won't buy a vehicle, you'll subscribe to transportation services.
Yeah, to a certain degree. I mean, people kind of almost do that with leases and things like that.
True.
I don't know that we will fully go there.
Well,
you've got insurance considerations. There's a whole lot there, and if you're like me and you're cheap, you buy a car and pay it off and drive it for a few extra years, right?
That's what they're trying to avoid, of course, as you know.
I'm going to keep buying them, though, and doing that.
I got you. Yeah. I got you. All right, so some of the other economic news, were you surprised at the 75 basis points the Fed laid on us on Wednesday?
No, when I was in here, 2 weeks ago, we said they're going to go 75. There was talk that they might go 1. And I was like, I don't think they're going to go 1. I don't think they're going to go 50. I mean, they need to continue to make a statement on inflation, because if you look at the underlying economy right now, the underlying economy actually isn't terrible. Now, the inflation is hurting a lot of Americans, so it feels like a recession.
Yeah.
But when you go and you look at Q2 versus Q2 a year ago, nominal GDP has increased by 10.1%.
Yeah.
So the economy is still growing. We're just not outpacing the inflation. And if that continues for a prolonged period of time, then, there's going to be some real economic damage here. Yeah. But if they can get the inflation under control, then I think it sets things up pretty well for the economy.
And so what we're saying is with the nominal measurement is that we're not factoring in inflation as part of that. Yeah. Here's the thing, though, as you know, Jeremy, what people care about is their personal situation. And we're getting into this ridiculous public argument about, are we in a recession or not? Honestly, that is really considered such a dirty word in politics. Oh, my gosh, he presided over a recession, which is why the White House is busy to try to detach themselves and spin the 2 consecutive quarters. People, I think, at the end of the day, don't care. What they care about is, what do they got coming in? What does it cost to live going out? And are they better or worse? As simple as that.
Well, and I think what you saw, especially when Walmart reported earnings this week, was they talked about their consumer kind of not spending as much money on some of the higher margin things because they're having to spend so much more money on the groceries and basic clothing and things like that.
Right.
So it is, for the masses of middle-class Americans, it is having a major, major impact. But it's not necessarily creating a huge contraction in the economy, right? This isn't a contraction like you saw where there was a big decline in what we produced in 2008 or 2020 with COVID. We're still producing more every single quarter and every single year. We're just, again, not outpacing the rate of inflation right now.
And I think that's the bottom line issue. But so how do you feel? I mean, personally, we got a break right here. When we come back, you can answer that. Just about your outlook on overall economic conditions and for the economy in general. We got Jeremy Nelson, partner at Element Wealth, in the Element Wealth Studios. We'll come right back. SuperTalk Mississippi in the Element Wealth Studios. Jeremy Nelson, partner at Element Wealth, is our guest in the studio. So we were just talking about all this economic news we got. Something we were discussing, Jeremy, before we went to break at the top of the hour when you came on the program, was just how this ESG concept and this initiative is gripping the private sector. Now we seem to have these sort of wars between big holders of assets such as state governments and some of these banks that are totally focused on ESG, to the point where they won't even finance fossil fuels projects. We're seeing private equity. We're seeing commercial banks as well exit that business. I think it's California's PERS, their public employee retirement system. They will not invest in any companies that are just remotely involved in the fossil fuels industry. An announcement last night broke from West Virginia. Of course, West Virginia, a big coal producer, and they said they will no longer do business with, they named 5 banks because of their decisions to reduce their involvement in the coal industry.
So obviously there's very nuanced issue going on here, but it's well within West Virginia's rights to do this.
Sure.
You're talking about not financing one of the major industries in their states. I think that when you're talking about the asset managers, though, right, like a CalPERS or something like that, the pension system, we have Mississippi PERS, you got CalPERS.
Right.
When you're talking about restricting certain investments, not on the basis of an economic or fundamental reason,
right,
then it could be argued that that's a breach of fiduciary duty.
You should place financial performance above politics and ideology, which is what's going. They're doing the reverse.
And I think that when it comes to the ESG movement, look, if you're an individual and you want to invest in an ESG-friendly way, that is 100% your right, because it's a free country and there are products out there, like that BlackRock runs and others do, that will enable you to do that. Yeah. Great, free country. Do with your money what you want to do with it.
Sure.
But to really mandate it and cram it down on everyone is not right. And I think at the end of the day, the consumer and people will vote with their wallets, right? Yeah. So if there are companies where reports are coming out that they're poisoning the water or doing something that's so terrible to the environment that people stand up and say, well, look, I don't want to buy your product, that will take care of the problem itself.
Yeah.
Right. And that's my position, is you got to let the free market sort this stuff out versus cramming down ideological things on people.
So there is a Republican congressman, his name escapes me, but I saw an interview with him yesterday. He's planning to propose legislation that would require your industry, wealth managers, to act on the behalf of their clients in such a way that financial performance in return, in accordance with your client's strategy, as they have communicated to you, is placed above. You're making investments based on your political philosophy or your political agenda, such as in climate change companies or companies that have a high degree of focus on ESG. Well, what would you think about that?
I just think it's ridiculous, right? It's not the place of the government to mandate these things.
I agree.
Right? And, like for us, for instance, for clients, we've owned Exxon and we've owned Chevron.
Sure.
And this year, that has been a great diversifier, right? We saw value in these companies, and we see these companies that are, look, they're working to be cleaner.
Yes.
But the reality is our country doesn't run if we don't have an energy source.
Yeah.
And so, we made the decision that it was in the best interest of our clients, those that own individual stocks or dividend-paying stocks, that these were good companies to own, and it's benefited people.
Yeah.
it should not be the government's place to tell us that we can't own.
I agree. It gets too complicated when you start trying to sort that out and try to it's just more crazy law you got to go worry about and comply with. I totally agree, and I don't want to see anything enacted at the federal level, certainly, that just puts another burden on the investment industry.
Look, the EPA is in place to control emissions and put regulations on that kind of stuff. Like that's their job.
Right.
Let them do their job.
Yeah, I agree. And we should also point out, as you rightfully do, we still have to power our economy with fossil fuels, and when there's no capital being injected into that industry, we don't have any fossil fuels. I mean, they rely on that investment. It's not like they got a pile of money sitting there that's going to power them for a sustained period of time. They rely on that capital.
Yeah.
And when that capital dries up, so does the oil and gas. When that happens, we just all shut down.
Well, and then I saw a ranking of ESG companies. I think Tesla fell off the list, like out of the top 100, right? They were in one of the more high-polluting ones, even though they're an EV company. I mean, realistically, how do you measure this?
Because they're not unionized.
You can't. It's impossible to fully measure these things. It's so subjective.
I agree.
That there's absolutely no way that you should be pumping regulation.
All right. So we talked earlier about this dispute we have in the public sphere about are we in a recession or not? You know, it's my view that the average person doesn't care. The definition being 2 consecutive quarters of contracting GDP. It's accurate to say it's not a hard, fast economic principle.
No. And so, I mean, basically, there's a bunch of economists that will sit back and look in hindsight and determine whether or not we were in one. Now, every once in a while, it's obvious, right? 2008, it was obvious. Yeah. 2020 with COVID, it was obvious. You knew that there was a big contraction going on. Right now, it's not obvious. Could they say that technically we're in a recession? Maybe. But like we were talking about earlier, the underlying economy is growing. We're just not outpacing the inflation. We're not actually seeing a real contraction in the economy right now. So, our outlook is actually, I mean, not completely rosy, but last time I was on 2 weeks ago, I said 75% chance. I mean, I feel like we have seen the bottom in this correction. And now we've been rallying up pretty good here, so at least we got a lot more room to cover if we were going to retest the lows. But what you're seeing with corporate earnings is we've got half the year behind us, and it's projected that S&P 500 earnings are now going to be up 8.8% for the year. A little bit lower than was anticipated going into the year, but if corporations are growing their earnings at 8.8%, that's not indicative of a big recession right now.
Yeah, and Apple, with their performance, their numbers released yesterday, what it seems to indicate is that people are addicted to that technology. They're still spending money on that. You heard Cook say, iPhone sales are strong and subscriptions are strong.
The areas of the market that are being the most affected would be advertising. So it does seem like corporations are pulling back a little bit on advertising.
They're all reporting bad.
Some of that has to do with the fact that Apple changed their privacy settings, which, thank you, Apple, for that. I appreciate that on my phone. But, overall, general consumption has been good. The savings rate is going down, right? People are having to spend a little bit more of their money because of the inflation. But, again, I think that the outlook is okay right now. The number one thing, and we've talked about this the last few times I've been on, we've got to see these inflation numbers come down, because the longer this goes on, the more structural destruction it can do. But, again, we're pretty confident that later this year we're going to see these numbers coming down. We're probably peaking around now.
It kind of feels like it. Yeah. I would agree. And we go into the fall, come out of the summer. Southwest Airlines just reported earlier this week that they've essentially returned to the pre-pandemic level with respect to business travel. You saw that as well. So I was a little surprised to see those numbers.
I'll be on an airplane up to New York in a couple of weeks.
Well, there you go. Yeah. So, it's not, I wouldn't call it doom and gloom type time whatsoever.
No, absolutely not. And I think for listeners, look, the number one thing is, if you've been sitting on the sidelines, you don't have to race in, but you got to come up with a plan and start staging in, because it does seem like we're setting up for a bit of a recovery here.
Yeah, I agree. And most of the investment analysts I've paid attention to this week, it's what they're all saying.
Yeah.
They're all getting better.
And you can even get paid on bonds now because interest rates are up.
Make a little money on bonds.
You got a few more options now.
I agree. Jeremy Nelson, partner at Element Wealth, has been our guest here on Middays in the Element Wealth Studios. Stick around. We'll be right back. Thanks, Jeremy.